Uber has had a rocky road to profitability since its inception. The initial idea was that scaling up would eventually make the company economically viable, but the opposite happened. As Uber grew, it burned through cash at an alarming rate, up to $10 billion annually in 2019, 2020, and 2022. Despite some promising signs of profitability in 2023, the company faced a significant setback in Q1 2024, reporting a staggering $654 million loss instead of the anticipated $474 million profit. This loss, driven by poor investment and legal battles, underscores the fragility of Uber's business model. The company's gross margins are a mere 40%, whereas tech giants often boast net margins around 40%. Uber's net margins, on the other hand, barely reach 2 to 4%. Even slight changes in ridership or operational costs can push Uber back into the red. Back when Travis Kalanick was CEO, he would point to revenue growth as a silver lining. However, revenue growth is now plateauing as Uber nears market saturation. From its 2009 seed valuation of $3.86 million to $80 billion IPO in 2019, Uber's valuation soared 21,000x. Yet, in the last 5 years, its growth has been just 50%, revealing a maturing but volatile company. Before Uber, the taxi business was highly profitable for medallion owners, with medallions costing over $1 million by 2011 and delivering an average annual return of 16% from 1951 to 2011. Uber disrupted this market by ignoring traditional regulations and creating a new model based on supply and demand. Initially, Uber offered premium services, but as Lyft entered the market with a cheaper model, Uber followed suit with UberX, leading to a race to the bottom. Tech companies like Google and Facebook scaled rapidly due to their efficiency. However, Uber's model doesn't have the same scalability. Each ride still requires a driver, and scaling involves significant overhead and expenses. Uber's business model led to extensive dilution of shares, with over $25 billion raised and $10 billion spent on stock-based compensation. Despite a valuation of $137 billion, Uber's return on investment is unimpressive, highlighting its scaling struggles. Uber's operations are incredibly complex, with 4,500 microservices and 4,000 engineers making updates 100,000 times a week. This complexity, combined with global logistics, driver safety, and regulatory challenges, makes achieving profitability a steep climb. For Uber to justify its high valuation, it needs to significantly boost both revenue and profit margins, a daunting task given its current scale and market volatility. Uber's path forward is uncertain. To meet its valuation expectations, Uber must either substantially increase revenue or improve its profit margins. With the company's intricate and capital-intensive model, this is a significant challenge. Even with growth, Uber's stability remains precarious, making it one of the most fragile tech companies in the market.